Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Right up front, just a quick reminder that this deep dive is for market context and discussion only and is not personal investment advice or an investment recommendation.
So, Daniel, imagine waking up today completely prepared for a grueling high interest rate winter. Like, you've reviewed your portfolios, you're mentally bracing for this brutal slog of sticky inflation and tight margins.
Right, totally bracing for impact.
Exactly. And then you step outside and find the market throwing a $1.8 trillion summer block party. I mean, that is exactly what happened today, Friday, April 17th, 2026.
It's honestly wild to really appreciate the whiplash of today's, 1,800-point peak surge in the Dow. We kind of need to zoom out. We have to look at the incredibly divergent macroeconomic regime we've been operating in all year.
Yeah, because for months, the old rules of cyclical economics they've simply stopped working.
They really have. I mean, we are navigating an environment driven by massive acyclic capital expenditures. Take the major tech hyperscalers, right? They are actively deploying roughly $635 to $650 billion in AI capex.
And the crucial word there is acyclic. In a normal business cycle, if interest rates hit 5%, companies just stop building data centers. Borrowing is too expensive.
Exactly. But when you are fighting an existential war for artificial intelligence supremacy, you kind of don't care about the cost of capital. You just spend that money anyway.
Right. And running parallel to that corporate spending spree is the fiscal side of things. We have the One Big Beautiful Bill Act, or OBBA, which is acting as just pure, unfiltered adrenaline for domestic GDP.
Yeah, and the mechanism driving that is this permanent 100% bonus depreciation and immediate R&D expensing. So instead of a company writing off the cost of a new factory slowly over 10 years, they just deduct the entire massive expense on day one.
Which creates a really fascinating tension for the market. I mean, on one hand, OBBA is wildly boosting near-term corporate earnings.
Oh, massively.
But the mechanical trade-off is that it projects another $4.1 to $5.5 trillion onto the national debt.
Wow, yeah.
And when you combine that tidal wave of government borrowing with an ongoing, fiscal restructuring of global supply chains, you create an environment where the Fed is essentially forced to keep interest rates higher for much longer than anyone wanted.
And the market was entirely priced for that reality. Add in the severe geopolitical fracture, specifically, the energy shock from the Middle East, and investors were absolutely bracing for structural, sticky inflation.
Yeah, they were.
And then the script completely flipped. So to understand how we arrived at today's record highs, let's open up session one. What set the stage before the U.S. session?
Well, to grasp the sheer euphoria that hit the floor on Friday, you have to really feel the baseline anxiety traders were carrying over from Thursday.
Right.
Because on Thursday, April 16th, U.S. indices were drifting upward, sure, but the mood was incredibly fragile. We got tighter than expected labor data Thursday morning, with initial jobless claims actually falling to 207,000.
And let's just quickly unpack why a low unemployment number is actually a massive headache for the markets right now.
Yeah, go ahead.
If there are no mass layoffs, the labor market remains exceptionally tight. Employers have to keep raising wages to attract talent, right? That makes the Fed's inflation fight exponentially harder because consumers have more money to spend, which just keeps prices elevated.
Exactly. And building on that anxiety, we had very hawkish rhetoric deployed by Fed officials on Thursday. New York Fed President John Williams and the San Francisco Fed's Adam Shapiro both pointed explicitly to sticky, commodity-driven inflation.
Yeah, I remember Williams noted the Fed was perfectly positioned to maintain their current restrictive target rate, basically because core inflation metrics simply aren't cooling fast enough.
Right, and the downstream effect of that commentary anchored the 10-year Treasury yield near 4.26% on Thursday. And, looming over all of this data were the physical bottlenecks in the Middle East.
Oh, absolutely. As of Thursday afternoon, the Strait of Hormuz remained completely unresolved. We were seeing reports of sanctioned supertankers trying to navigate a military blockade.
Yeah, so the physical risk premium on global energy was very much alive. But then the overnight geopolitical bombshells hit.
Yeah, massive shift.
Late Thursday at 5:49 p.m. Eastern Time, President Trump made a massive announcement. He stated that Iran had agreed to abandon nuclear weapons and hand over its nuclear dust without any financial exchange.
Which is just a huge headline.
Right, and with formal negotiations resuming over the weekend, that initial headline was a shockwave.
But the real earth-shattering event for the global economy arrived early Friday morning, didn't it? Around 4 a.m. Eastern Time.
Yes, exactly. Iranian Foreign Minister Araghchi announced the immediate reopening of the Strait of Hormuz to commercial shipping.
And if you are tracking global trade, you know the magnitude of that specific waterway opening back up just cannot be overstated. The Strait handles roughly 20% of the world's daily oil supply.
It is quite literally the most critical energy choke point on the planet.
Yeah. By reopening it, the worst-case scenario of a prolonged, devastating supply shock was basically instantly wiped off the board. The market reaction was violent. WTI crude oil immediately went into a massive pre-market sell-off.
Because, look, if oil prices normalize, the cost of manufacturing, shipping, raw materials, it all drops. Core inflation could theoretically resume its downward trajectory.
Which is the exact scenario equity markets have been praying for. I do want to challenge this narrative for a second, though, Mira.
Okay, what are you thinking?
Is this euphoric repricing of geopolitical risk entirely premature? I mean, a diplomatic headline is just ink on a page. Physically clearing naval mines from a major international waterway takes a massive amount of time, specialized equipment, careful logistics.
You don't just sweep for mines overnight.
Exactly. Plus, fragile ceasefires in this region have a really long history of collapsing. Are we seeing algorithms price in a permanent fix to what might just be a temporary Band-Aid?
Well, it's a crucial distinction between the paper market and the physical market.
Yeah.
You are absolutely right that if clearing those mines takes months, the temporary energy spike could still harden into structural inflation.
Right.
But in the pre-market session, the algorithms trading these futures contracts, they don't care about the logistics of mine sweeping. They are programmed to react to the perception of headline risk.
That makes sense. The moment the headline risk vanished, the buy orders flooded in.
Exactly. The perception of risk evaporates, and the capital moves instantly.
So, to tie a bow on Thursday night into Friday morning, we witnessed a massive diplomatic de-escalation regarding the Strait of Hormuz, causing oil futures to plummet and equity futures to absolutely soar. It perfectly set the stage for a wild open. We're going to take a brief pause on our end, but stick around. When we return, we'll look at what happened when the opening bell actually rang. Welcome back. Let's move right into session 2. What moved markets during U.S. trading hours?
Well, the moment the U.S. session opened on Friday, we saw a historic, face-ripping repricing. The S&P 500 surged 1.2% to close at 7,126, and the Nasdaq climbed 1.52% to 24,468.
Just incredible number.
Both of those are fresh record highs. But honestly, the undisputed star of the session was the Dow Jones.
Oh, the Dow action was staggering. It temporarily spiked over 1,100 points intraday before settling 1.79% higher at 49,447. And the catalyst driving this absolute risk-on environment was the energy sector.
Right, WTI crude oil plummeted roughly 10% on the day, closing at $84.68 per barrel.
A 10% drop in crude in a single session is just a monumental repricing of global inputs. Equities were basically throwing a parade.
They really were.
Yeah.
But here's the fascinating divergence. While equity traders were celebrating the end of inflation, central bankers were actively treating this oil drop like a false summit.
Yeah, they were throwing cold water on it all day. Right in the middle of the trading day, at 2 p.m. Eastern Time, Fed Governor Christopher Waller came out with a highly cautious tone.
He did. He explicitly warned that despite the massive plunge in oil prices, the risk of a lasting structural increase in inflation remains. He strongly signaled that U.S. monetary policy needs to stay restrictive.
And that sentiment was absolutely mirrored across the Atlantic. Later in the afternoon, around 3:03 p.m. Eastern Time, ECB Representative Kocher synchronized perfectly with Waller's messaging.
Right. Kocher warned the European Central Bank against taking any preemptive rate cuts amid lingering uncertainty, even with energy prices falling in Europe.
Because central banks don't want to declare premature victory, they are terrified of cutting interest rates based on a volatile commodity headline, only to realize they are only halfway up the mountain if those shipping lanes close again, you know.
Exactly, and inflation just roars back.
Yeah.
That hawkish commentary had an immediate, tangible effect on the fixed income market. Logically, with oil down 10%, you would expect bond yields to collapse as inflation fears evaporate.
You would, yeah.
But the 10-year Treasury yield barely edged down, settling at 4.22%. The bond market completely ignored the equity euphoria and listened directly to Waller and Kocher.
Which brings us to perhaps the most fascinating paradox of the entire trading day. The behavior of gold.
Yes.
I mean, if geopolitical risk just vanished overnight and the Middle East conflict is de-escalating, why did gold advance 1.34% to a record near $4,868 an ounce?
It's a great question. If you're relying on the traditional 60-40 portfolio playbook, gold is a classic safe haven asset. It historically spikes when conflicts erupt, and it sells off when peace breaks out.
Right. Since oil plunged on a ceasefire, gold should have plummeted alongside it.
But it didn't.
Because it's no longer tracking the Middle East, it's tracking something much closer to home.
Precisely. Investors are aggressively seeking non-yielding inflation hedges, but they are hedging against the structural deficits of the 2026 fiscal regime.
Like we talked about earlier with the OBBBA legislation.
Exactly. The market is looking at that $4.1 to $5.5 trillion being projected onto the national debt. Gold isn't trading as a war hedge today. It's acting as a fiat currency hedge against massive, unprecedented U.S. deficit spending.
That completely isolates it from the energy shock. It is a brilliant illustration of just how complex this 2026 environment is.
It really is.
So, wrapping up the U.S. session, we experienced an explosive equity rally driven entirely by a 10% plunge in oil. Yet this occurred against a backdrop of deeply cautious central banks keeping bond yields sticky, while gold surged on long-term domestic fiscal fears.
That sums it up perfectly.
We'll take one more short breather, and next we will pop the hood on the specific corporate earnings driving these indices. All right, let's get into session 3, corporate events recap and what to watch next.
Well, we have to start with the absolute bedrock of today's market resilience, which is the tech and consumer spaces, specifically Apple.
Oh, yeah. At 6:02 a.m. Eastern Time, well before the market opened, Counterpoint Research dropped a massive data point.
They showed that Apple's iPhone shipments in China unexpectedly surged 20% in the first quarter.
And you have to put that in context for people. China is arguably the most critical growth market for Apple.
Right. And for months, there have been deep, lingering fears about severe geopolitical headwinds and rapid market share loss to domestic competitors over there.
Yeah. So a 20% shipment surge completely shatters the broader narrative that consumer tech is contracting in Asia.
As a result, Apple shares climbed 2.65% on the day. Because of Apple's sheer market cap and its massive weighting in the major indices, that single piece of fundamental news provided a heavy structural floor for the market.
It really gave the Nasdaq and S&P 500 the runway they needed to just run to those record highs once the oil news hit.
Absolutely. But while mega cap tech was pulling the broader market up, the financial sector gave us a masterclass in the high grading mechanism.
I love talking about this. Think of high grading like a corporate immune response. In a zero interest rate world, the market tolerates bloated, inefficient companies.
Oh, totally. They can just borrow forever.
Right. But when the cost of capital is expensive like it is now, the market becomes ruthless. It extracts capital from low-margin businesses and forcefully injects it into highly efficient, cash-rich machines.
It's a flight to quality on steroids, basically. And we saw this executed perfectly in the Q1 bank earnings released Friday morning.
Let's look at where the capital flowed first. Ally Financial reported at 7 a.m. Eastern Time and absolutely crushed EPS estimates, posting $1.11 versus the expected $0.93.
Wow.
Yeah, the stock soared 8.44%. It essentially proved that consumer auto lending remains incredibly robust despite consumers facing higher borrowing costs.
And shortly after, State Street reported at 7:15 a.m. Eastern, they posted record total revenue of $3.8 billion, beating estimates, and their stock rose 4.55%.
That is a crystal clear signal of strong capital markets activity and healthy fee income for asset managers.
But as you said, the immune response also punishes the weak. And I want to explicitly note that this next breakdown is mainly relevant to listeners who are actively tracking the regional banking sector.
Okay, let's hear it.
Truist and Fifth Third Bancorp both reported at 6:30 a.m. Eastern Time, and both fell down 0.77% and 1.3% respectively.
So while the rest of the market was throwing a massive party, these regional banks were selling off because they missed revenue or top and bottom line forecasts.
Right. And the mechanics of why they missed are really vital to understand. High non-interest expenses, fierce deposit competition, and rising credit provisions.
This is exactly how a delayed rate path exposes structural flaws. If the Fed is forced into a higher for longer stance, retail customers realize they don't have to keep their cash in a checking account yielding nothing.
No, they move their money into treasuries yielding 4 or 5%.
Exactly. And to stop that deposit flight, regional banks have to raise the interest they pay out, which actively crushes their profit margins. The market sees that structural trap and punishes them for it.
Spot on. Now, before we move completely off the corporate tape, we should briefly cover the industrials, specifically for the auto and industrial subset of listeners.
Go.
Autoliv reported at 6:30 a.m. Eastern Time. They beat EPS estimates, coming in at $2.05, and their shares surged 12%.
Which proves there is underlying mechanical resilience in global auto supply chains, really defying earlier fears of deep industrial sluggishness.
It really was just a perfect storm of positive, micro-level drivers feeding directly into the macro euphoria.
It was. Investors are celebrating so hard today that the only nuclear dust we're seeing is the trail left behind by the major indices blasting to record highs. With oil plummeting 10% and the Strait of Hormuz wide open, the only choke point left in the world is the line of bulls rushing to buy Apple stock. Let's ring that closing bell and lock in these massive gains before Governor Waller realizes how much fun we're having.
I love that. The trading floor might be closing, but the narrative is constantly evolving. Here's what to watch next over the next 24 hours and heading into the weekend.
All right, what's on the radar? First, weekend developments in U.S.-Iran peace deal negotiations and Strait of Hormuz shipping traffic. Second, market reaction to Netflix's post-earnings drop and potential tech sector contagion on Monday.
Third, continued digestion of Q1 bank earnings and deposit flight commentary. Fourth, updates on the Israel-Lebanon ceasefire agreement duration.
And fifth, Federal Reserve speakers for further clarity on monetary policy in light of cooling oil prices. Which brings us to a final thought for you to ponder as we wrap up today.
Yeah, we just witnessed a massive relief rally because an external energy supply shock was seemingly resolved. But think about the underlying domestic forces at play.
Right. If the massive $650 billion AI CapEx cycle and the unprecedented U.S. fiscal spending from the OBBBA legislation keep the economy running red hot, will domestic strength eventually become its own headwind?
Will the market eventually be forced to reckon with the Fed's higher-for-longer reality, even if global energy supply chains return completely to normal?
It is the ultimate question of whether the economy can actually be too strong for its own good. We'd love to hear your take on that, so please share your thoughts in the comments.
Thanks for listening, and we'll catch you next time.